Good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Anything said in this piece is an opinion only, not financial advice, not investment advice, purely to enhance your knowledge and give you a little bit of background to financial markets. So let's kick off. So today we've got a lot to talk about, and let's have a look at what has been driving markets yesterday and what will be driving markets going forward. Okay, as follows. So we've got UK inflation to talk about. We've got December retail sales in the US. We've got Microsoft to talk about. We've got Amazon to talk about, the bond yield, FX, cryptos. Let's move on. Okay, so the biggest news yesterday, well, wow, one of the headlines was Microsoft. So CEO Satya Nadella, not Satya Nadella, Satya Nadella, the CEO of Microsoft, sent a letter to all employees to start buckling up. They're laying off 5% of the sales force, which is 10,000 employees. And she explained to the staff that during the pandemic, purchases of software and hardware went through the roof because everyone was in lockdown at home, so therefore everyone needed IT services or IT equipment or any particular type of devices in order that they could facilitate them working from home. Sorry about the rocky ride. Let's try and keep it a bit stable, okay? Right. So she wrote a letter to all the employees, telling them to buckle up. Now, Microsoft is a massive component of the NASDAQ. Microsoft and Apple make up around about 22.5% of the NASDAQ. So whatever they do has a big impact where that index goes. Microsoft itself, its environment, its overall atmosphere there is very, very relaxed. I mean, they do provide huge amounts of good terms and conditions for the staff there. And what she's actually said in the letter, that everyone now needs to get ready, tighten up and get ready to work hard. In other words, up until now, the atmosphere has been very, very relaxed, and that's likely to change at Microsoft because their profits have dipped and their earnings have dipped simply because companies are pulling back and holding back on expenses, and it's impacting Microsoft. Now remember, Microsoft is effectively a bellwether with a couple of other high-tech companies of where the sector is going. So whatever Microsoft does, it's very important to follow and see and indicate. It's effectively a lead indicator to one of the lead indicators to the sector. So with those layoffs, that shocked the market. Now the market was more or less okay with that news. It didn't really move significantly until the US December retail sales came out. However, before we do that, let's just talk about the PPI, the Producer Price Index, which is wholesale inflation, came down lower than expected yesterday, and that did push markets up as the pressure on rising interest rates will be released and will be reduced, and therefore that did is gave a boost to financial markets, that there would be less pressure to raise interest rates as wholesale inflation comes down. If wholesale inflation comes down, then surely retail inflation will come down as well. Then came out the December retail sales in the US, which were worse than expected, and that effectively was the nail in the coffin for yesterday's trading. The Dow dropped over 600 points, the Nasdaq dropped, S&P, Bitcoin dropped, and also US Treasuries dropped, and we'll go into that in a second. Now the retail sales in the States, they were expecting them to fall, however they came in at minus 1.1, which is a huge drop. And because retail sales dropped in the States, which again is an indicator as to where, not a lead indicator, it's already a historical indicator, but it's an indicator as to where the economy is going. And with layoffs and with retail sales dropping, the reduction in wholesale inflation was not sufficient to maintain the market up at those high levels, and the markets were sold off across the US, Europe, and UK and Asia. If retail sales are falling away, then that will have a bigger impact on corporate earnings, because less money spent by the consumer means less money landing in the pocket of the corporates. In addition to that, other layoffs, well, we know about Goldman Sachs. Bank of America has frozen all hiring due to rising costs. Effectively, they made step one, they're the freezing hiring. They'll probably be laying off people in the next month or two, but have not yet announced that. They are concerned about the economy overall. Amazon is laying off 18,000 staff, and all of this staff have to go and find other jobs. Now, there is a general shortage of labour in the employment market globally due to the pandemic and due to deaths and sicknesses. However, it's not every sector needs staff. In the high-tech sector, which has led the way over the last 10 years to markets rising, will now lead the way into markets falling. I've been saying that all along. I did give the assumption yesterday that I would probably see markets rising all the way to mid-February, but economic numbers and economic factors will have an impact. Not really at this stage, not really 100% sure where the markets will be going over the next month. However, over the next year, they are going down. We're going to see a 25 to 30% drop in equity markets in the next 12 months as the recession bites. And the first part of recession biting is rising cost of borrowing, which we've seen, rising inflation, which we've seen, and now rising layoffs, rising unemployment. There will be high unemployment this year, not across the board, but by sector. So the high-tech sector will see rising unemployment. Interestingly enough, the US 10-year Treasury came off 16 pips yesterday to 338. That's also an indication that interest rates are not going to rise much further because the bond market is a lead indicator as to where interest rates are rising. And that came off 16 pips. Also came off 16 pips because worried about recession. If the recession overall, then people are going to get into trouble financially and there's going to be less money floating around. As regards to foreign exchange markets, the dollar unusually was weak against the pound and the euro, a bit stronger against the yen. The Japanese have kept their interest rates at 0.1% and haven't given any serious guidance going forward, and therefore the Japanese yen was sold off, therefore dollar yen rose. Oil slightly came off. It went up to $82 a barrel. Brent went up to $86, $87 a barrel. It's the first time it's been above $80 in about a week. If it continues rising, that in itself will have an impact, obviously, on inflation. China reopening up will be sucking in huge supplies of oil to get its massive industry moving. In the UK, inflation came in at 10.5%. That sent the pound up. It was actually lower than expected. However, because it's solid at 10.5, it doesn't seem to be moving that much. The pound has gone up. So you expect the pound dollar, which is cable, to go up to around about the 125 in the near term. Near terms the next, I would say, week or 2 weeks. And over the next 4 or 5 weeks, you could see cable at 127, even 128. The euro also has picked up because the interest rate environment in Europe is stronger than it is now at the moment in the US. So the US have got tapering off of interest rate rises, but in Europe you're going to have rising interest rate rises. Christine Lagarde has clearly stated that they're going to aggressively tackle inflation, so that's going to push the euro up against the dollar. I don't know how long that's going to be sustained, because as Europe goes into recession, then obviously that's going to impact further on the euro. Okay. So you've got foreign exchange, you've got a slight weakening dollar. The dollar is probably going to continue staying weak over the next few weeks unless there's something shocking comes out, and you're probably again going to see strength in the euro, the pound, a bit of weakness in the yen, and a bit of strength in Canadian dollar and Aussie dollar. As regards cryptos, well, obviously as the market comes down, Bitcoin being a high risk asset was also sold off, came off from above 21,500 all the way down just below 21,000. I've got a gut feeling it's going to go to 25,000 Bitcoin. As far as Bitcoin's concerned, it's I don't know, I think it's got a bit of steam in it. There's a lot of enthusiasm to get it up there. So you could see Bitcoin back up to 25,000. But if markets continue being sold off, then it's also going to be sold off with the rest of the markets. However, I think the traders are absorbing the retail sales, and if the economic downturn does not dominate the headlines, then you could see the markets again to the end of January pick up further. But come February, March, you're going to see the markets turning south, turning into a significant bear market and being sold off as the economy goes into crunch time and starts to enter more into a deeper recession, a worse recession than 2008. That's more or less it for now. And you can subscribe, you can share with friends, comment, and you can watch me on Instagram and TikTok. Have a good day.